In late January 2026, the global markets for precious metals experienced an extraordinary period of both triumph and turmoil, with gold and silver reaching record nominal peaks in price before suffering one of the most dramatic sell-offs in decades. On January 29, 2026, gold was trading near its all-time highs, with spot prices in the US dollar zone exceeding $5,500 per ounce. Silver, riding a wave of speculative enthusiasm and rising industrial demand, had soared to levels above $120 per ounce, figures that represented stunning gains compared to the metal's trading ranges just weeks earlier. Both metals were being driven by a combination of geopolitical uncertainty, strong ETF inflows, and widespread investor belief in a structural bull market. Analysts at the time spoke of gold hitting ever higher peaks, and silver's meteoric advance seemed to defy traditional commodity patterns. That brief moment of euphoria, however, gave way to a sudden and sharp reversal in late January and early February 2026. The catalyst for this reversal was multifaceted. Key among the drivers was the nomination of Kevin Warsh as the next chair of the United States Federal Reserve, a development that strengthened expectations of more orthodox monetary policy, buoyed the US dollar, and diminished some of the safe haven appeal of gold and silver. In tandem, futures exchanges like the CME Group raised margin requirements, pressuring leveraged traders and triggering forced liquidations. What had been near parabolic upside momentum quickly turned into intense technical selling, and the plunge was swift. By the end of January, specifically around January 30, 2026, the prices had reversed sharply from their peaks. Gold futures plunged nearly 9% in a single session, dropping to approximately $4,194 per ounce from the recent all-time highs just days earlier. Silver's fall was even more dramatic. It lost over 26% of its value in that same period, briefly dipping below $75–80 per ounce during the most volatile sessions. This magnitude of decline was widely reported as one of the steepest sell-offs since the early 1980s for silver and one of the most severe for gold in many years. Investors watching the markets witnessed a nearly 30% drawdown in silver from its January high of about $121 and a roughly 10 to 12% drawdown in gold from levels near $5,600 per ounce. The shock of this reversal rippled through the financial markets, unsettling traders and prompting widespread headlines about the historic crash in precious metals. As prices tumbled, the narrative quickly shifted from exuberance to fear. On February 2, 2026, global precious metals markets continued to feel the pressure, with spot gold trading around $4,670 and silver near the $80 mark, extending the sense of extreme volatility and deep losses for many holders of physical and paper positions alike. At these lows, gold was down roughly 10% to 12% from its peak reached just days earlier, and silver was more than 25% lower from its record highs. Many participants wondered whether the rally was truly over or simply undergoing a necessary reset. Yet, the very factors that had contributed to the initial sell-off also helped sow the seeds of the rebound. Bargain hunters, technical traders, and asset allocators who viewed the sharp sell-off as an overreaction began stepping in. On February 3rd and into early February 4th, both metals started to recover meaningfully, initiating what would become a notable percentage bounce from the recent lows. On that rebound day, gold staged what was described as its largest single-day gain in years, climbing as much as 6% or more from its immediate trough levels. Spot gold prices were once again flirting with the psychologically important $5,000 per ounce threshold, even as they remained down from the January record heights. Silver's response was even more pronounced. After hitting lows near $72 to $80, silver prices surged by roughly 11% or more in the same rebound session, climbing back toward the mid-$80 range. Some reports even characterized silver's recovery as up over 20% from the deepest recent lows. Thus, in the span of just a few days, gold had staged a recovery of roughly 10 to 15% off its sudden bottom, reclaiming a significant portion of the ground lost during the crash. Against the backdrop of a drawdown that approached approximately 10 to 12% from peak to trough, this rebound reclaimed nearly all of the intraday losses, bringing prices back into territory only slightly below their prior highs. For silver, the rebound was arguably more dramatic because its plunge had been so steep. From a trough that saw prices down more than 25 to 30% from record highs, silver's rally off the bottom captured around 20% or more of that losses, pushing prices substantially higher within a short time frame. It's important to recognize that while these recovery percentages represent powerful V-shaped rebounds from the lows, both metals remain below their absolute peaks as of the early February snapshot. Gold's recovery back above $5,000 still leaves it slightly lower than the $5,600 plus high seen just a week before, and silver's climb into the mid-dollar ADS remains well below the $120 plus levels achieved at the peak of the rally. Nevertheless, the speed and scale of the recovery underscores the resilience of these markets and the intense volatility that characterizes risk assets like precious metals during major macroeconomic shifts. Analysts have echoed that this kind of sharp correction followed by a pronounced bounce is not uncommon in markets driven by speculative excess and leveraged positioning. Some industry voices suggested that the drawdown represented a necessary technical correction rather than a structural end to the metals bull run. They noted that the factors that initially propelled gold and silver higher, geopolitical tension, inflation uncertainties, institutional demand, continue to underpin longer-term demand. As of early February 2026, forecasts from major financial institutions remain bullish on gold's prospects into the latter part of the year, even as silver's outlook was more tempered due to its dual role as both an investment asset and industrial commodity.